before we had this deterioration and tensions picking up in the Middle East, our view was that OPEC would sit on their hands and they would continue to hold the market tight, and we would be looking at an oil price around the $75, $80, even $85 a barrel if demand began to re-accelerate, not just in China but also in the US. And so if indeed OPEC are pretty comfortable, which we think they are, with the current constraints that they've put on the market, of course, a pickup in demand would start to see oil prices higher relative to lower. I think the key is, though, that if you did have an event which did cause disruption of oil exports, and that's not even talking about, you know, the issues you could have in the Strait of Hormuz, for example, which would cause a much bigger dislocation. What you would actually find is that OPEC would want to provide a little bit more oil back to the market as a way of keeping the price pretty stable.
And how are you watching the sort of demand from China angle in all of this, given the big stimulus announcement that we've had in recent weeks? We're hearing from the NDRC, the economic planner, tomorrow. Hopefully we'll get more substance as far as some of the specifics and the details about this fiscal and monetary coordination with regards to policy. But I mean, we have seen the impact broadly on commodities as far as sending up those iron ore prices, copper prices. But oil seems to have been taking a more sort of pragmatic approach to this whole thing, I suppose, traders out there, because of the sort of other moving parts in the market. So how does the China demand story fit into this equation?
Well, definitely, I think most of us are sitting waiting for the fiscal expectations. And because from a monetary perspective, clearly, you know, the monetary policy per se was not restricting consumer demand in China. It was mainly around sentiment around real estate. It was sentiment around broader growth in general. So clearly fiscal policy has to do the heavy lifting here. And from an oil demand perspective, that's also the case. So if we saw some recapitalisation of local governments, for example, you would start to see some of those projects that have been held up just on the constraint of capital from local governments who are not making that return from land sales anymore and so forth. That would start to play out a little bit more. And the consequence of that is that you would see an improvement in broader industrial production, manufacturing and so forth. Remembering, though, manufacturing in China has been very solid on a sort of year-to-date basis. And so it's more internally the shoring up of the real estate market and that starting to shore up sentiment. When we think about iron, supplies at iron ore inventories at steel mills was very low. It was elevated at ports, but it was very low at steel mills, and steel production was coming down. However, if you steady steel production, they need to restock. That needs to lift demand for iron ore more generally, and that won't just be satisfied by what's sitting in inventory. Not only that, but exports from India and other high-cost producers had come down pretty significantly.
And if we look at demand for other commodities,